Good morning. China's gold market is no longer driven by retail swings. It's being structurally bid higher by institutional capital, with insurance giants quietly stepping in as a new and powerful source of demand. That's the China update. Insurance buying grows, boots on the ground. Second China story, China just extended its gold buying streak to 17 straight months, adding more to reserves and signaling a steady policy-driven shift towards gold at the core of its long-term strategy. It's the highest purchase volume in over a year, and they bought the dip, as the title says. This is the Gold Fix market rundown, and here's the markets. 10-year yields are 424, down 6. The dollar is 98.79, down 72. The S&P 500 is 67.94, up 171. NASDAQ is 25,027, up 279, 280. The VIX is down 5 percentage points at 20 spot 50. Gold is up $85, $86 at 47.87. Was as high as about 48.35. Silver 76.83, up $3.80 some odd cents. Was also significantly higher than that. Uh, the Shanghai silver premium to US is shrinking, which means the buying is not from China this morning for the most of it, for the most part anyway. And we'll get into that in a second. Copper is up over 2.5%. WTI is the biggest contrarian for all these commodities. Oil is down $15.69 at 95.17. Very weak. We'll pull those charts up as well. Natural gas down 11 cents, also affected 277. You can guess what the news is, but let's get through the markets first. Platinum is up $108. Palladium is up $65. Gold, silver is weaker at down 2 at 62.26. Bitcoin is up over the last 48 hours, but unchanged right now, settling in the 71,600 area. And grains are mixed with soybeans up. Okay. What does this board tell you? Well, this board tells you that we didn't end the world last night. We didn't destroy one of the oldest civilizations on the planet, which was President Trump's threat. So 11th hour negotiation was brokered. And so we have a 2-week ceasefire, which may or may not extend into 4 weeks, which may or may not go beyond there. I'm not going to get into details right now, except to say that the tit for tat is essentially we stop bombing you if you open the strait unconditionally for 2 weeks. And they stop bombing back. Now that this could flip at any minute. This is, you're dealing with people here. So there's nothing final right now. We're in the teeth of this, and it's going to happen. And we are, believe it or not, from a precious metals point of view, still in the desert. I'll get to that when I get to the charts. But the most important market is oil. The oil is down $15, $16 almost now. After almost touching that high, that could have triggered another buy rally. So I think what you looked at is 11th hour rescue of a market that was on the verge of possibly breaking much higher. One for Trump, I guess is what you would say. We think this is a really important story, uh, and the audio accompaniment that we put with it, kind of like a mini podcast, uh, explains why. So let's just read what the story is itself. China update, insurance buying grows. China's gold demand is shifting from cyclical buying to structural allocation, driven by macro uncertainty, institutional adoption, and supportive policy. Onshore premiums, rising SGE volumes, and resilient ETF inflows confirm sustained strength, while insurance participation and retail platforms broaden demand, reinforcing a durable and increasingly diversified bid beneath the market. Just to touch on that audio portion that I sent. About a little less than a year ago, China opened up gold ownership to insurance companies to offer as product to institutional and retail investors. So basically, an opening up of the gold market even further to retail access for insurance purposes was test piloted last year or middle of the year last year, I think. and it turned out to be very well. But right now, insurance buying is now opened up to about half of the insurance companies out there, which is why you have an institutional Chinese bid, which is also why sidebar, which is also why silver is suffering. China has been very, uh, it was a bad move letting silver be such a retail alternative investment to gold. And that UBS fund that was attracting all the buying, they put the kibosh on that, and all that money is flowing into gold now. So that's why silver is trading 70 some odd dollars, because it should never have been trading $120 to begin with. Sorry to say. I mean, it will be trading there again, just not tomorrow. I'm not complaining about uh, silver that's up four times uh, my most recent buys, uh, even though it's 50% off the highs. It's just crazy, right? It is silver, though. Okay, so that's the first story. That's, we think, extremely important story when you're looking at the thesis and ideas that we've conveyed here for the last 2 years. To see a continuation of it, this is an opening up of gold ownership to the Chinese citizenry, and it's very much policy driven, very similar to what Reagan did with stocks in 1982. And you can listen to that in the podcast. Second story, which is the bigger story in terms of mainstream media coverage, is China bought the March gold dip. Right, China's central bank extended its gold buying streak to 17 consecutive months in March, adding roughly 5 metric tons to official reserves. Who knows what they bought on the QT? According to data released by the People's Bank of China, their biggest public purchase since February 2025 occurred during the March gold dip. So they bought more on the dip. That's a great sign. But it's also a sign that they're not going to chase the rally. The more they buy on the dip, the less they're going to chase on the rally. And that's where we are now. We're in a market that's structurally getting bid. Remember, Tether bought a lot of gold. Tether sees this as well. You're going to see insurance products in the US offering gold products. It's going to happen. Okay, so those are the two stories, the two main stories, I should say. Yesterday, we put out the French deflection that was about the gold that France decided to sell to us and buy back over in Europe, still paying for shipping from the UK to Paris. Who knew? Who knew that we wanted to buy that gold in the US? The reality of it is they bought that gold when gold was rallying. They bought their gold between January 25 and December or January of 26. They bought the gold during the rally. They were one of the buyers. So why would they do that? Look, I just want to put another finer point on this. Why would you? I understand if you don't want to take back the shitty gold format that they had since World War II. I understand that. But why would you sell the gold and then buy it back when you could just do a swap and then take delivery out of London? Why would you not just do a swap? Why would you literally sell the gold and buy it back? I'll tell you why, because there was no fucking gold. Excuse my French. Get it? There was no gold. If there was, they wouldn't have been buying gold in a rallying market for the last year. Anyway, that's the final word on that. There was no gold, or they would not have done that. You just do a swap. You do an EFP. Why would you sell it here and then buy it there? Why would you do that? It's ridiculous. You do a swap. Anyway, moving on. Today, Fed minutes are released at 2 p.m. So you could have a type of market where you have the market behaves one way before the minutes and the market behaves another way after the minutes. But the real big news is the fact that we didn't blow up Iran last night. Again, PCE is on Thursday and CPI is on Friday. Goldfix members exclusive bullion pricing now available. Goldfix has partnered with Battalion Metals to give our community access to institutional grade physical bullion at exclusive member pricing. Through this partnership, Goldfix members can purchase gold and silver products at pricing typically about 100 basis points below prevailing dealer rates. And we're getting some people that are using that now, and we appreciate it. And we hope that they appreciate it as well. Close to the best prices we've seen out there. There's maybe one or two other guys out there. Some of them may not ship. Let's get to the charts. There's the oil market. Okay, just for the traders who look at a chart and feel like they have to trade something, if you want to trade this from the short side, you have three entry points. One, you sell it now and you find a stop level to put in. Two, you sell it on new lows on an intraday chart and use an intraday high or low on a candle to stop yourself out. Or three, you wait for a retracement and a kind of a bear flag confirmation being formed, and then you sell weakness after the bear flag is formed. That's basically it. Buyers, good luck with that. No, it's if you're going to buy it, you just buy it. You just close your eyes and you buy it, and the market goes up because Trump changes his mind tomorrow morning. Who knows? But anyway, gold. Now, while you're looking at the gold chart, let me just zoom in on this a little bit. While you're looking at the gold chart, it may be incredibly confusing why gold is rallying on peace and why gold is selling off during war. Because this is a dollar, just to reiterate, this is a dollar funding crisis for Middle East nations. Oil could be trading $1 billion, but if they're not selling any, they still have to pay their debts and they still have to pay their bills in dollars. So if the oil's not leaving the strait, you have a dollar funding crisis. And what a dollar funding crisis means that you have to sell things that you normally wouldn't sell to raise dollars. And one of those things is gold. Another one happens to be treasuries. They're selling far more treasuries than they are gold now. And that's because we think that this gold market is going to become an HQLA down the road, or a repo market, or a market where you don't have to sell it to get the dollars. But right now, you still have to sell it. It hasn't been augmented in that way yet. So coming back to the whole, it seems kind of ironic or unfitting for gold to be that way. I would put it to you this way. If you're trying to get a handle on it, instead of judging it, look at it this way. The US is so in need of rate cuts right now that this war really screwed with the Fed cutting rates. It's so in need of rate cuts that gold and stocks sold off when the war started, and oil, which is the stagflationary commodity, rallied. So all you need to take away from this, or what I'm taking away from this is, wow, this is me just talking to myself. Wow, gold really like that. Isn't it ironic? And then the next sentence I say to myself is, wow, the Fed must really need to ease if the stock market is that weak, if even gold is backing off. So that's my take on it. Silver overperformed because this is about a rate cut. All right, it's not over yet, but um, let's talk about the desert a little bit. Go back to gold. The desert. Okay. We got above my most recent purchases, thank God. Um, I purchased some last week. Okay, I'm tempted. I'm really tempted, because I'm genetically bullish, to look at this break above here and say if we settle above 4,800, 5,000's on the table. Okay, that's that's does that mean buy it if it sells above 4,800? For me, it does. Yeah, it means buy it above 4,800 and then put a stop out between 4,800 and 4,780, give or take. But it doesn't mean that for you. I think these two here are pretty significant. And the fact that we're back below it means it is pretty significant. And unless we can settle above 4,800, I'm going to say that this is just going to be basically be more sideways chop. But we're well above the 100-day moving average. Silver actually looks better. Silver is above the level that I would be worried about, 76 and change. So above 76 and change, dare I say it, 79.29 is my next level. Above 76 and change, 79.29 is my next level. So basically, if you're looking at it through the lens that I look at things, We're trading 77.24. If we're above 76, let's put a number on it so you can see it quantified a little bit better. If we're above 76.12, if you were to buy it here, don't buy it here. But if you were to buy it here at 77.30, you would risk to 76.12, which is a buck 10, to make a target of $80.12. I think I say 80.12, right? 80.18. 80.18. So you're risking one to make three, which is really not a bad trade. The question is, can you stomach losing $1? You have to use really small size if you're trading disciplined. And that's it. I'm Vince. Have a great day.